Right. That was Tech Voice. We were taking a look at matters of how you should, what are the factors or the elements you should be considering before you go out there and buy yourself either wired or wireless headphones. Your choice, both have their pros and cons. You can take a look at that video so that you know what exactly you should go for. Now, right about now, let's get into the launch. And here we are joined live on Zoom from Kingdom Securities Limited in Nairobi, Kenya, is Willies Walwenge, who is the CFA, Head of Research at the Kingdom Securities Limited. He is joining me right now live on Zoom to discuss matters of the capital markets. Good morning to you, Mr. Willies.
Good morning, sir.
I am glad to have you here with us today.
It's a pleasure.
Yeah, maybe before we go into the conversation, you could introduce to us what Kingdom Securities is concerned into.
Okay, Kingdom Security is a subsidiary of Cooperative Bank, and we are purely a stock brokerage company, and our work is to deal with buying and selling of shares in the stock market. We also do give advisory services to our clients, and at the same time, we do what we call transmission. Transmission is the passing of shares from the deceased to the ones who are supposed to inherit it. And then there's something called immobilization. Immobilization is just transferring shares from the certificate system to the CDSC account. So basically, that's our work.
All right. And you are the CFA there. What does that entail?
Sorry. It is Willies Walwenge CFA. CFA is a designation on Chartered Financial Analyst.
Okay.
Basically, my role is Head of Research. Our work in research is to analyze the economy, analyze the companies, analyze the situation that will force the company to either make profits or losses, and then advise the clients on which shares to buy, which shares to sell, what direction the stock market is going to take, and how it's going to be affected by the economy in general.
Great. So you are qualified to having this conversation with us on capital markets. Maybe for someone who does not exactly understand, people are used to money markets. What do capital markets have?
Capital markets entails all sources of financing for your businesses. There are different sources of financing. One of them, of course, is savings. And then when you go to source the third-party money, we have two methods. So in the equities market, that is where we deal with shares, where we have listed shares. That is what we have in the Nairobi Stock Exchange, or the unlisted stocks, where we have some companies like, for example, Family Bank, which have shares with the public, but they trade over the counter, which you call the OTC. So that is a section of the equities. On the other hand, we have the bonds market, where a company goes and floats a bonds to the public, and the bond normally has a tenure, the term, and the rate of return. So capital markets entail both the equities market and the bonds market. But now when you narrow it down, then we look at the equities market on its own, and then we look at the bonds market on their own.
All right. Now, let's start from the bonds market. I understand there are government bonds and also there are companies that float themselves out there. And from the understanding I have right now is that these are considered mostly risk-free investments. Why are they risk-free?
The reason why they're considered risk-free is that we know that it's very rare that a government will go out of business unless there is an emergency or a forceful takeover of the government, or unless the government goes broke. So the reason why they're called risk-free is that there is a certain guarantee that the government will ensure that it makes dues in its payment, both in terms of interest and upon maturity, they will pay the principal.
All right. So this is the safest bet.
We have seen it is the safest bet for anybody who is afraid of risk to enter into.
All right. Now, and if you want to invest, of course, in this national treasury bonds and bills, how exactly does one begin in the process of doing that?
Okay. Maybe I can start with Treasury Bill. Treasury Bill is what we call a discounted paper, meaning that what they request for or what you pay for is not what you receive. For example, if they requested for 100 shillings and they've said 5%, means that you'll give the government 95 shillings, meaning that when the government is paying you out, they'll pay you out the 100. So it's a discounted paper. That is a weekly auction. It's normally released on Thursdays, and all you need to do is go to the Treasury CBK and you'll fill the forms to request for a CDSC account with the Treasury, and then you deposit your money directly from your bank account to the Treasury account. Minimum investment in Treasury bill is 50,000 with a maximum of how much you feel like. We have 3 different papers in Treasury bill. We have the 91-day Treasury bill, we have the 364-day paper, and then we have an 182-day paper. So depending with the tenure, then you know that the rate of return will be different accordingly.
And how are the returns? What is the period of return on investment?
Now, they're normally an annualized paper, meaning that if I say 91-day paper and I give you to it at 6.5%, the 6.5 is annualized. So what you do, if you want to know what you're going to get after the 91 days, is you take the 6.5 and divide it by 4. The 364-day paper, which is equivalent to a year, when I tell you 6.5%, then at the end of the period, you'll earn the 6.5 in full. As of the moment, we have the 364-day paper at 7.7771%, meaning that at the end of the year, if you bought it in the last auction, you'll earn 7.77%, while the 91-day paper was at 6.81%. So again, you take the 6.81% and you divide by 4.
What are some of the factors that affect how the bonds are issued? For example, if the National Reserve, the external reserve increases or reduces, does this have an effect on the bond, the bills?
The bond is, the treasury bills are purely what we call cash flow financial needs for the government, and that's the reason why they issue them weekly. So the essence of it is dependable on the liquidity in the market, meaning that if there is high liquidity in the market, then the rates and the treasury bills will tend to go down. If there's tight liquidity in the market, as the rate we are going currently, then we'll see the rates going up. That is number one. Number two also will depend with the government needs. The government normally requests for about 24 billion per week. So depending on how much money is bid on, remember that if they ask for 24 billion, does not mean they'll take the 24 billion. If the market offers 35 billion, and it's cheap money, meaning that the rates are going down, then the government can take more than 24 billion. If the market offers, for example, 20 billion, but they're requesting for high rates of return, the government has an obligation of even taking less than the 20 billion. They don't have to take the 100%. So depending with the rate, depending with the liquidity in the market, and depending with how much demand the government needs, then that will determine how the rate will go and how much will be absorbed by the government.
Right, so 2 points, liquidity and demand. And is there a way that someone can cash in before the maturity date, and what is the process around that? Are there penalties involved as well?
Yes, you can buy and sell the treasury bills in the stock exchange, or what we call over the counter. In fact, there is no stock exchange trade for that. It's purely over the counter. That is when you approach stock brokers like Kingdom Securities, and then we'll source for either the paper to buy or the paper to sell. When we get the client, we do the transaction. Unfortunately, unless you are holding a very large sum, for example, we're talking about 50 million and above, then the rate of sale or purchase might be below what we call the market rate. But depending with the demand and your need for funds, then the client will analyze their return and then decide if they're selling or not.
Right. So if I have a relative who invested in bonds and bills and unfortunately we lost them, is there a way that a third party can claim that amount?
Yes, there is a process. Number one, it's either through the will, if they'd already written a will, to hand it over to you. The second is through a letter of administration where you go to court, claim on the returns, and then you approach the likes of Kingdom Securities, and that is what I call the transmission process, where we do the transaction for you through the central bank, or you can even go directly to the central bank with the letter of administration, and you can claim the funds directly. So if I can also talk about the bonds, we only talked about the T-bills. I said the T-bills are discounted paper and they have a term of up to 1 year. Treasury bonds are long-term papers and have more than 1 year. That means 2 years and above. They're normally issued every month. T-bills are issued weekly. Bonds are issued monthly. and they have what we call a coupon rate. The coupon rate is what will determine how much return you'll get. Now, the coupon is paid twice a year, meaning, for example, if you get a coupon of 10%, after 6 months, they give you the 5% return, and then at the second 6 months, they give you the second 5%. If the bond is for a 5-year tenure, means that you'll get 10 coupons for every year twice, and then on the last day of maturity, you'll get the final coupon plus your principal. Remember that bonds are long-term papers, and they're recommended for those people who, number one, look for frequent cash inflows through the coupons, and number two, they want to hold investment for a long period of time. And then also it is used for tax management. There are bonds that don't charge taxes, and that is the infrastructure bond, for example, the one that was released in the month of September. Anybody who bought that bond, it's a 21-year bond. So you will hold the bond for 21 years. You'll get the coupons over the period of time, but that does not charge tax. On the other hand, we have what we call a fixed return bond, where it charges between 10% and 15% depending on the tenure of the bond.
All right. Now, if this is all the exciting stuff that is happening in the other side of capital markets, that is on T-bills and bonds, why should one also then invest in stock markets?
Okay. Stock markets has the advantage of entry and exit. Remember that I've said bonds and treasury bills have a tenure, meaning that you have to go in for the 91-day or the 5-year. For stock market, you can get in today. When the shares settle, you exit immediately. Number two, bonds are normally used for cash flow management and low risk. In the stock market, it's for those people who have appetite for risk, and they can be able to read the market very fast. They have good returns with proper timing. That is what we call the capital gains. And then it has different offers. Remember, bonds, you only get them either in companies that issue the bond or the government. But when you go to the stock market, you get different sectors of the economy offering the bond. For example, agriculture, we have media, we have telecom, we have the banking sector. So you can be able to switch from one sector to the other sector depending with which area you perceive will have better returns. And then there's also the advantage of calendar timing. We know when the companies announce, the shares tends to go up. For anybody who has the appetite for risk and is able to manage their timing properly, then that's where the return comes in. On the third phase, maybe I can say that there's the advantage of the dividend payment. There are companies that pay dividend. For those people who are going long term, then they invest in the companies that they pay the dividends, and they can be able to receive the annual return on the same while awaiting for the capital gains.
Right. And now let's move over, of course, to the authority that is the National Securities Exchange. How does it operate when it comes to these stock markets?
Okay, Nairobi Stock Exchange is purely a market like any other, where they facilitate the listing of the shares. Or maybe I can just take you back a little bit. There are different players in the securities market that we know. Number one is the investment bank and the stock brokers, who are the front office that meet with the clients. Number two, we have the Nairobi Securities Exchange, who are the authority to list companies and to be able to manage the movement of the pricing, and to be able to advise to provide information on the market in general. And then we have the CDSC, custody of shares. They're the ones, when you buy the shares or sell the shares, they are the ones who hold them in custody for the clients. And then we have CMA, Capitals Market Authority, who are the regulators of the market. So Nairobi Securities Exchange is purely the market where you see the listed companies, but when you buy the shares or you sell the shares, then they are held at the CDSC, that's the custody depository services.
Right.
So, but when you want to buy the shares, you go to the stock broker or the investment banks.
Right. Now, then, if you are getting into NSE, what are some of those requirements before you go and trade?
Okay, what you need to do is visit a stockbroker, and then they'll open a CDSC account for you. To open the CDSC account, you need a copy of your ID, a passport photo, your KRA PIN, and also the source of where you will want your dividends to go, or when you sell the shares will go. Mostly as of the moment, everybody is recommending that you provide a bank account so that it eases the hassle of writing checks and such entities. So that should be the main thing that you need to do. The moment you open the CDSC account, you can immediately start trading in the stock market. So it's very easy to go in and go out.
So apart from the registration process, of course, of opening up a CDSC account, what are the other reasons that one should engage with a brokerage firm when they're getting into this type of market?
Mostly is about the advisory service. We do write research papers to advise clients which direction the market is taking. So it's very key for any investor in the market to try and follow up with their research departments of the stockbroker to see which direction the market is taking. Number two, individuals need to be vigilant about what's happening in the economy or what's happening to the company they've invested in. For example, if you hear Safaricom is going to Ethiopia, you know that Safaricom will be able to generate more revenues, meaning that they'll be able to invest further and capital gains. If you hear the likes of the Cooperative Bank and the KCBs have posted high profits, then you know that the returns of the company are going to push the stock prices higher. So those are some of the things that you need to be vigilant in. But generally, we advise clients to be in touch with the stockbroker to know which direction the market is taking, because we have trained in that, we have specialized in that, and that is the role of the stockbroker, to be able to advise the client and be able to make best return for the client in general.
Right, best returns for the client in general. Now, at Kingdom Securities, how would the cost look like for me if I came through for those services?
Okay, the cost of trading in the market is normally provided for by the regulator. As of current, we have approximately 2.212% in terms of commission, and that is for anybody who's trading less than 100,000 shares. If you're trading more than 100,000 shares, then you're able to negotiate with your broker. Again, remember, to trade in the NSE, you're only required to request to purchase 100 shares on the minimum. That will determine how much you're going to invest in the stock market. For example, Cooperative Bank shares are going for about 13.5 shillings. So for minimum investment, you'll need 1,350 plus the commission of 2.212%. On the other hand, if you're going to buy EABL is currently going at 180 shillings per share, meaning that you need a minimum of 18,000 shillings plus the commission. So depending on which stock you're buying, the minimum investment will be determined by the cost of the share. Then after that, you buy a multiple of 100, meaning that if I buy 100 shares of Cooperative Bank, then the next ones I'll be buying is a multiple of 100, 100, 100. So I can buy 500, I can buy 600. That is on the minimum, on the overall.
Right,
Yes.
Quite an interesting take there. I wish we had so much more time, because I have a lot of more questions and to engage you on. But maybe before we wrap this up, do you have any hotcakes of where people can invest this week?
Yes, I can be able to give advice on that front. Number one, I will recommend for anybody who is thinking of going long term, meaning I'm talking about 3 years and above. Safaricom is a very good stock for the moment. The banks, Cooperative Bank, KCB Bank, Equity Bank, are very good, considering that, again, there's a potential of capital gains and the potential of dividends payment. We have banks like Absa, which also have a very good and upside on that front. There are companies that pay very good dividends. Unfortunately, they're very expensive for people who are starting up. The likes of BAT and EABL pay very good dividends. So those people who are thinking of going long term, then those are stocks that they need to engage in. For the people who are looking speculative, unfortunately, I'm not able to advise that, considering that the market changes every single moment. So that we need a one-on-one strategy so that they can be able to know where the market's going and how fast or how easy they can be able to get in or get out.
Right, a few free tips there, of course, from Willies, who is also the head of research there at the Securities. Now, because we know that you have a lot of work going on and we have a lot of more questions and a lot more to discuss, we are hoping that we can have you at a later time so that we can also release you to continue with your day's activities.
It will be my pleasure.
Right, thank you very much. And guys, that was Willies Walwenge, of course, helping us understand what the capital markets look like. There's a difference between capital markets and money markets. Capital markets are the ones with bills, bonds, and stock market exchange. So make sure that you are able to go and get the right information and invest right and invest well so that you can get those returns and you can better yourself in this particular economy you're in. Thank you very much. I'm going to take a short break, but coming right up is the winners of Red Bull Basement Challenge 2020. What did they do? What can you do to be like them? Stay tuned.